Hello and welcome to my channel, The Quality Investor. Earnings season continues apace this week. However, the market is not happy that the Fed has decided to hold off on lowering interest rates, but businesses continue to post solid earnings. Tuesday, Coca-Cola, ticker KO, released their earnings. Last quarter, Coca-Cola was the target of some market irrationality. The fear was over new weight loss drug, Ozempic. Well, when Coca-Cola released their earnings for Q3, those fears proved to be a big nothing burger. With the Q4 earnings on Tuesday, however, Coca-Cola continued its steady yet turtle-slow growth. Ozempic is clearly a non-factor, and Coca-Cola demonstrated some very important points about their business, especially given the slower consumer economy that we're experiencing right now. Coke's brand power is unparalleled, and Warren Buffett says this manifests in what he calls Coke's positive share of mind. This means that the soft drink occupies a special and positive place in the minds of the populace. People simply associate good things when they think about Coca-Cola. That is the foundation of Coca-Cola's economic moat. And one aspect of an economic moat is the ability for the business to raise prices while simultaneously maintaining or growing market share. Well, for me, that's what I took away from their earnings release. Coke demonstrated why they have such a powerful brand. All right, let's get into these earnings. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, don't forget to share this video and hit that notification bell so you can know right away when I post more stock analysis content. Okay, so we're starting out on the income statement for Coca-Cola, and we can see for the year ended 2023, revenues, they're up 6.4% year over year, and earnings per share is up a very nice 12.7% year over year. However, I like to look at the margins because the margins tell the story if the business is growing their moat or if that moat is contracting. Okay, so we can see the operating income, and in total dollars, it's up 4% year over year. However, the operating margin is down to 24.7% from 25.4% last year. That's a 70 basis point decline. Basically, they're becoming a little bit less efficient in managing their overhead. But the gross profit, however, that's up very nicely. Not only do they have a 9% whole dollar increase for gross profit, their gross margin is up to 59.5% from 58.1% last year, 140 basis points. To me, this is what quantifies that powerful brand, that economic moat Coca-Cola has built, which I will point out here in a second. So this is the highlights section of Coca-Cola's full year performance. And this is the line that caught my eye. For the full year, net revenues grew 6%, which I pointed out, to $45.8 billion, and organic revenues, non-GAAP, grew to 12%, driven by, this is the important part, 10% growth in price mix and 2% growth in concentrate sales. This 10% price mix growth, this is the moat that I've been talking about. Companies' ability to increase revenue while simultaneously either increasing their sales, gaining their market share, that is a strong economic moat. And this demonstrates Coca-Cola's power. Coca-Cola can raise their prices and the people will still buy their beverages. This is a breakdown by segment for Coca-Cola's revenues, and you can see that price mix increase of 10% consolidated basis, but that was really driven by Europe and Latin America. And Latin America even drove the unit case volume. This is another metric Coca-Cola likes to use to demonstrate their growth. So they grew 5% in unit case volume. That's how much they're selling in Latin America. And taking a quick look at Coca-Cola's outlook for 2024, they're expecting revenue growth to be 6 to 7%. And as far as earnings per share, growth of about 4 to 5%. But I did want to point out the free cash flow on their outlook. They are expecting $9.2 billion in 2024. That is a slight decline from $9.7 billion, however. So Coca-Cola, they grow, but it's very slowly, so don't expect world-beating returns with this company. All right, so what does Coke's current valuation look like? Are they worth buying right now? So looking at some growth rates here, I have the revenue projected to grow 5% in 2024. Remember, I pointed out on their full year outlook, they are expecting about 6 to 7%. So I'm using 5%, knocking off a percentage point there. Operating margin at 28.5%, net income at 23.5%. for their margin. And ultimately, I am projecting a little bit less in free cash flow. Remember, I like to be conservative in my estimates here. So at $9 billion there. And going forward through the next 10 years, I am projecting just 5% growth ultimately for Coke. And you got to remember, that's the curse of these slow growth companies. They're not going to have great year-over-year revenue growth. And operating margin, I'm expecting that to expand to 33.5% and their net margin to expand to 28.5% here. And that ultimately gives us free cash flow growth of 8.6% over the next 10 years, which you can see is a little bit less than what their 5-year compound annual growth rate is, higher than what their 3-year compound annual growth rate. So, this is a guess ultimately, but this is sort of a mixture of what analysts are projecting and my own conservative estimates. So one tool I use that helps me project what these margins should be is I look at their operating margin here. This is a chart that I have built, and you can see that they've done a very good job of increasing that operating margin, especially in the last 5 years. So I believe it's pretty reasonable that they can expand that up to 33.5%. And you can also see down here, the free cash flow margin, ultimately I have that expanding to about 29%. You can see that high mark here in 2021 of 29% for free cash flow. So ultimately, here is what I believe Coke's valuation is. So that discounted cash flow, after I plug in those growth rates, that gives us a $66.43 per share price. The dividend is at $52.32, and that's a dividend growth of about 4.5% perpetually. And my exit multiple is at $71.96. For the exit multiple comps, I am using Pepsi, Monster Beverage, Dr. Pepper, and National Beverage. And that comes out to an average of a 28.9 PE ratio. And you can see currently Coke is sitting at a 23.8 PE ratio. And that's where we're getting that high, nearly $72 exit multiple price. So you can see based on where Coke's PE right now is on a trailing 12 basis, that 5-year average is actually at 28.9, which is right around that average. So I suppose it is reasonable for Coca-Cola to get back up to this price. And continuing on here, we can see that the valuation average is at $64.29. And right now they're currently trading before market opens at $59.29 with a potential upside of 8.4% and a margin of safety at 10%. I'm using 10% because I believe Coke is a very safe, slow growth company. That gives us an acceptable buy price of $57.86 or a wait recommendation. And honestly, if you're buying Coca-Cola, you're not buying it for those 12, 15% per year returns. You're buying it because you want that dividend income. And it's a nice stabilizer in a portfolio because they will provide growth, albeit very slowly. You can see on a 1-year basis here, they're essentially flat. I mean, this line is basically flat. So Coca-Cola pays a nice dividend. You're going to get that 3% plus yield, and you're going to get very slow growth. You have to understand that going in when you buy Coca-Cola, but it is a very safe and very good company to own. As always, I want to emphasize that this is not financial advice, and I do own a stake in Coca-Cola. With that, thank you for watching today's video. And what do you think? I love the feedback, so please comment below with your thoughts. Also, please hit that like button, and if you found this info helpful, consider subscribing to the channel and joining our community. Thank you, and happy investing.